All right, guys, my name is Jason Clement, and I've been asked to come and address you today. I've known about QS2 for about 2 months, so I'll just tell you I'm still understanding a little bit about the company, and certainly network marketing is not my strength. My strength is only in insurance. Luckily, we have great leaders surrounding me on the network marketing stuff, and they've been teaching me and helping me understand a little bit how to combine those two industries. And it's been an interesting 2 months, I'll have to tell you. I've been running an independent insurance brokerage for close to 6 years, almost 7 years. And it's a traditional brokerage, and I own it, run it, and it's evolved and grown and taken its own twists and turns. So I come from that type of a background, and so the topic was left a little bit open. You know, I asked for very specific stuff so I could drill it down, but they said, here's some things that would like you to maybe discuss and cover. So I'm not going to try and go through heavy paperwork. I'm not going to try and go through some of those things. I'm going to tell you some of the things that I've learned and why I'm in the industry. And one of the nice benefits you have in a network marketing model, this type of QS2 program, is you get access to information that I had to find out on my own. Because in the traditional model, what's the incentive for someone to teach me anything in insurance? You guys are in insurance. A lot of you guys are doing insurance right now. There's no incentive for someone to mentor you, train you, give you all the information. There's just not. You're going to go find it out on your own, right?
Then you become a competitor.
Yeah, because that's how we do it. We R&D, rip off and duplicate, right? In Utah especially. So you become the competition inside the same brokerage, or you leave the brokerage. So the more experienced agents are more tentative in being willing to mentor anybody, okay? Not so here. In here, it's going to be a much more win-win situation for everybody. I'm incentivized to help you. That's not going to happen in a normal traditional brokerage. I'm not going to come up on a Saturday and Burke or Kelly or somebody else and come teach you all the stuff that we know, Mike. And because at the same time, it's an exchange. I get to learn from you, you can learn from me, and we also override each other and help build and recruit and together. So that's a unique situation in the insurance industry. My perspective and passion is different than Kelly's. You know, I have a different perspective in insurance. It's a big world. There's a lot of things that we can do together. QS2 gives us a big platform to do that. Like you said, it's independent, so we have health, life, and annuity, and PNC, and all these other things that we can do, right? Just so I can understand a little bit the audience, who is currently has any insurance experience at all? 1 year of insurance experience. So at least half the group. How many have their licenses? At least one insurance license. Okay. So we've got a lot of insurance professionals in here. Let me ask you guys in the audience, who makes the best long-term care salesman? If you're out there, disability, critical illness, term, who do you find in your industry is just killing it, is successful in one niche?
Someone who owns it themselves.
Someone who had a mom, let's say it's long-term care, right? Yeah. And you'll get in a brokerage or you'll get to a company and there's one person that just sells a ridiculous amount of long-term care. And why do they sell that? Why are they so darn good at selling long-term care? So you'll go talk to them. You'll say, why in the world are you 3 times our best reps in long-term care? He'll have a story. Every time he'll have a story. And the story leads to passion. And when you sit with a client and you have a story that's sincere and real, and you do it with passion, what happens? You sell because you're sincere and it's suitable and you believe it. And so they kill it in that niche. They may be horrible at selling an IUL or an annuity, but man, they just clean it up in long-term care. And you'll find that as you go out, QS2 is giving you a huge platform. It's an amazing platform. You've got health, and you've got life, and annuity, property casualty, and what your job is going to be, the way I see it, once again, this is just one person's perspective. This isn't they should put a big disclaimer up behind me. This is not the views or opinions of QS2, right? I just want to tell you that. This is just my own opinion, okay? Find your stories, find your passion, so that it's not just about a grind and getting up and trying to make money and do something. There's plenty of passion available in insurance. There's tons of it. I'm here because of it myself. My background is building. Can you tell? I have 9 fingers. So I was told by my wife, you're out. And had a couple of really close calls. I've got 4 surgeries on my lower back. I've got a plate in my neck. And so I was impatient. I was building. We were building big projects up in Park City and all over. And I helped remodel this hotel. My company remodeled the one over here and the one down the road, the courtyard of the Hamptons and the residence inns. We had commercial stuff going on. We had big homes up in Park City. So we had a big company and we were rock and rolling. Okay. So I had a little excess. And I have my brother-in-law works right up the road here at New York Life. He's a captive New York Life agent. He came to me and he said, I was getting frustrated because tell me if you've done this in your own life, but if you've made it in your industry and you've handed stewardship off to someone else to grow your accounts, right? So I had a Merrill Lynch guy, I had an Edward Jones guy, and they were supposed to do what for me? They're supposed to grow my net worth, right? So I would earn it in my industry, I would hand it to them, and they would say, oh, this .com is going to be great, this pre-IPO company, I got this insider information, let's buy this stock, let's diversify, all these things. So I would make it in my industry and I would lose it in theirs. And consistently I would do that, okay? And so I thought that's the only plan you have available to you, right? So I'm building, and then I get steered into a little bit of different, a little different event happens to me, where in 2007, in 2008, my world changed as a builder, right? And at the time before that happened, I had my New York Life brother-in-law said, there are financial services available for you in insurance. He said, well, tell me about them. What can insurance do to help build wealth? I've never heard of that before. And he said, come talk to some of these guys that specialize in that. It's a little boutique agency, and they do that. So I said, okay, I'll come talk to them. Well, I went down there and figured out that the insurance offers amazing, amazing benefits. And guess who the worst people are about selling themselves? The carriers. They're the worst at selling what benefits are available in insurance. They don't toot their own horn. They're so conservative, and the way that they're regulated is amazing. Okay, but there's amazing benefits in insurance, both for those that are beneficiaries and living benefits. It's an amazing world that insurance has, and it's never talked about. And so when I started to do anything, I'm a little bit fanatical. Those that know me, I'll drill down really deep. I'll get real granular. I'll go through every policy. I'll read the fine print. I'll go through, I visited every headquarter of all these companies that you're going to be writing through. Manor, West Coast Life, New York Life, Lafayette, Mass Mutual. Talk to their CEOs, CFOs, asset managers, American Equity, Allianz, North America. I've been to every one of their headquarters and talked to every one of those guys. That's just the way I am. When Jason said, I wasn't listening to the rah-rah on stage at the convention, I wasn't. I don't really, it's not why I was there. I was there to find out, is QS2 really going to survive? I want to talk to Kelly. I want to talk to Dan. I want to talk to all these guys. I want to talk to ORG, who provides life and annuity for you guys, right? And I want to talk to SME, who provides the property casualty insurance. I want to talk to every single person that was going to be involved in the success or failure of this company before I converted my brokerage and everything I had in full to this company, okay? And I think it maybe got them off guard a little bit, but they're great partners, okay? I was extremely excited. Kelly is who he says he is. Dan is who he says he is. His executive team is sharp, okay? So I started to get more and more enthusiastic about the possibility of this happening, of what Kelly was promoting here, and Jason and Mike had brought to me. And so I started thinking, oh, there's some possibilities here, okay? Back to when the market crashed in 2006, 2007, we started to see, okay, we've got some significant problems here, both in residential and commercial markets. And then we had around 6 million in construction at the time, just my own company alone, but we had partnerships outside that had more than that. So when that started to happen, where had my company focused contingencies? Everybody but the banks, right? I had contingency for suppliers, I had contingency for interest, I had contingency for extensions and buyouts and all this stuff in my company. I just figured the banks were going to be there for us, right? And so as we progressed into 2007, 2008, and all of a sudden these companies, including Citigroup, ends up getting taken over by the FDIC, right? They step in and they buy up all the investment bankers. And all of a sudden, I'm left with $6 million under construction. Guess who? We've never missed it ever, a construction payment to any subcontractor ever. We've got the most loyal group of subcontractors that will walk through walls for us because we have given them a tremendous amount of work, and we have a very personal relationship. I know all my subcontractors. I know their wives, and I know their kids. I know what they've been doing for 15 years. These are my friends and associates in the building industry. I can't pay. I can't pay them because they've frozen all the loans from almost about 3/4 of my lenders. So here I've got $6 million under construction. I can't pay them. This is one of the hardest things I've ever done in my entire life. I felt like the world was collapsing on top of me. I couldn't even hardly bear the pressure of it. At the same time, just prior to that, I had started to work with these guys to help others that I knew to start to use some of the insurance benefits that were out there, okay? So when I discovered that there's a tremendous amount of advantages, I quit giving it to Merrill Lynch and to Edward Jones, and I started to funnel into life insurance. And unfortunately, I hadn't started 10 years prior. So as soon as that went through, I went through the worst part of my life trying to deal with that downturn. I want to tell you what I learned, okay? Now, this is a little bit further away from you, but because I went through it, it was so painful to me, and it was so personal to me, and it was personal to people that I really loved and cared about, I became fanatical about it, okay? And I became extremely passionate about it. When I sit down and I compete for retirement income with the Edward Jones guy or Merrill Lynch guy, who wins? It's personal to me. I'm going to win that sale. Okay, I'm going to show you why and how, and why insurance has like Joe Jordan up on stage, if you were able to be at the event down in Las Vegas. This is an industry of passion. It should be. What you're doing changes lives. And if you don't have a story, use somebody else's until you have your own. But you won't be in the industry very long until you have your own story. And it might be long-term care to begin with, and then it moves over to term. And then it might be into IUL and an annuity, an income rider that's saving someone's retirement and helping them make it month to month. That's why you get up. That's why you recruit. That's why you sell insurance. For me, that's the way it is. And I had a very narrow focus on why I got into it. And we offer all the products, and we know the products. But some of you guys know what I'm talking about, all right? And I want to tell you what we understood, what happened, and my cynical view of the world, all right? When 2006, 2007 happened, and I'm just going to rely on Mike to kind of flag me down, because once I get going, you know, we teach 2 or 3 days, our brokers and agents are flying from the country, so I've got to really condense and be quick about what I like to teach and talk about. But what happened in about 2006 and 2000, well, let's go back to the 90s. We'll even go back to the 60s and 70s. What was the true, I have a different view on buy term invest the difference, and I'm not, what I think the redeeming value of A.L. Williams added to the industry was, buy term invest the difference, was that if you can ever find a financial shortcut for anybody, especially human nature, which is buy term invest the difference, everybody will do it. Was it popular? Absolutely. Did it redefine the insurance world? Absolutely. Was it appropriate and suitable for everybody that wrote it? Absolutely not. Okay? So, I have my own passion of what I'm doing in there, but it forced insurance companies to relook at their life insurance models. And I think that one champion phrase helped insurance companies become more efficient and more customer-driven and come up with more critical products that help become more competitive against the markets. Okay? That was a very, very good thing. Why did they need to invest the difference? Dave Ramsey, Susan Orman, right? All these talking heads have all these things to say. They had to invest the difference to cover their uninsurable retirement. When you get to be older, you can't get insurance, and so therefore, you better have a darn good retirement in place, because you're going to go through a lot of expenses in your later on in life. Here's what happened, and this is what all the money started leaving the insurance. We're going to put this as insurance company. This is the insurance industry. And if you look, let me ask you, when you drive into New York, I've met with executives at MetLife, I've met with executives at New York Life in downtown New York. When I was sitting and looking out over their windows, what do they brag to me about? Who owns New York? There's two groups. There's 2 groups. That's it. They own the entire skyline. And they'll brag right to your face, we own New York. Guess what else? We own Chicago. Guess what else? We own Houston, LA, Miami. We own 80% of every metropolitan in the world. They do. They're bankers and they're insurance guys, okay? They hold the notes. And everybody leverages the capital out of those companies, right? Okay, so there's really two big piles of money. But there's one more over here that was really popular. And it really got heated up in the 90s. Okay, the investment banks. So here's what happened. When buy to invest the difference started to take place, where did wealth go? This is wealth, by the way. This is true wealth. These are the stewards of all money in the world. Okay, these steward all of your money and my money. Okay? When buy to invest the difference took place, wealth was being transferred aggressively out of the stewardship of the insurance world. Right? And it was going in big numbers. Prudential, MetLife, all these guys were seeing New York Life. They weren't competitive. What were they competitive in? ROI. They couldn't give a return to you, and so they said, we're going to buy to invest the difference, we're going to stick it everywhere else. Okay, so insurance started seeing massive amounts in the 70s and 80s of wealth leaving the coffers and the stewardship of the insurance company. So we started getting things like the UL policy. And then we got the VUL policy, right? This is, by the way, how WMA made it, okay? Right? So they started trying to be competitive in a return. They didn't want the money to leave, so they said, look, we'll take a little bit, we'll do the term thing, but we'll invest it inside insurance for you, inside these policies. So they tried to stop the flow, but the flow was massive here, okay? And there's a point to all this. This ties back into you and the relevance of what you're doing here. The investment banks, we're talking about Lehman Brothers, right? We're talking about Merrill Lynch. We're talking about Goldman Sachs, AIG, on, right? Yeah, Bear Stearns, all these guys, okay? How was it that, why were they so appealing in the 90s? Why was all the wealth going over there? All the retirement wealth and all the money? Because they're regulated different than anybody else that had wealth, okay? Here's the interesting thing. You could go 25 to 40 to 1. One asset could be leveraged 25 to 40 times. If you can take one asset and leverage it 25 to 40 times, you're going to get a stronger return than a commercial bank. These are commercial banks. Commercial banks, we're getting 6 to 12 to 1 in regulatory tier 1 capital and the way that they were being dealt with, right? Okay? So how are these supposed to compete? CDs weren't looking really good, right? Right? Everybody could get all of this wonderful money and returns over here. So they grew like crazy. What happened in the 90s when that took off to the insurance world? Right down in here. Okay, let me tell you what we saw happen. And these guys were really open about discussing it with me. We saw a big split right down the middle in the insurance world. We saw that stock and a publicly traded insurance company was incredibly appealing. And it made perfect business sense in the late 80s and 90s. And so what did we get? We get a real fissure, a gap between companies in the insurance industry that decide to go stock. So we had MetLife and we had Prudential and all these guys over here. So MetLife, Prudential, all these guys said, we're going stock, we're going public, right? A whole bunch of them, a whole bunch are listed as stock companies. Well, who stayed? Okay, there's a difference. There's another group over here that are mutual or privately held groups. So there's New York Life, and there's Mass Mutual, and there's Northwestern Mutual. These are all mutual type companies. What's a mutual company?
I'm not sure.
Right, policies hold it. Policy holders own the company, and they elect the board, okay? So there was a lot of turmoil happening that A.L. Williams and others were able to cause, and it was a real efficiency model of 80 years of get off the chair and become more competitive, right? Well, why does that matter to us? By the way, it was so appealing that New York Life got a charter to go stock, Mass Mutual got a charter to go stock. All of them were this close to going publicly traded, sold out stock company. And they hesitated, and they hesitated, and they hesitated. And they just hesitated long enough to decide, we're just going to stay mutual. But they were really close. And today they still have the charter to go public if they ever wanted to go stock company, okay? Well, that caused a massive, massive amount of problems of wealth inside the insurance world for everybody, okay? Now what happened in the late 90s, we went through some bumps and turns, but these guys still survived it okay, all right? And then all of a sudden 2006, 2007 happens. What changes the world? By the way, this is relevant to the conversation you're going to have with a whole lot of people, because it's every time I sit down, it's relevant to them. Okay, how many people were hurt financially in 2007, 2008? Probably everybody in this room. It was a violent thing that we went through, right? All of us together. Well, what happened is when those got called, okay, and they're leveraged at 25, the perfect storm happened for the investment bankers. What happened to the investment bankers? All of a sudden, they were the coolest thing ever, became nobody wanted to touch them. And all of a sudden, everybody that had stock in those companies lost everything. And they're friends of mine, okay? Hundreds of thousands of dollars of stock, my friends. All these guys right here disappeared unbelievably fast. Where did they go? Where did they go? Okay? What happened over here with our wonderful government? Okay, we decided, because we're part of this, right? We decided to take our tax dollars and we were going to pick who winners and losers over here, right? Because some of them were too big to fail. Remember all these conversations about 5-6 years ago that we were having? So all of a sudden, this is a financial disaster. They don't know what's going to happen globally to everybody. We don't know what the ripple effects are going to be from this. It's the first time in scale we've gone through this as a whole world, right? So all of a sudden, these things start taking place. And in swoops about 3 major players. There's JP Morgan Chase, there's Bank of America, and there is Wells Fargo. There's others, but they got the lion's share of buyouts. Okay? So the government gives them TARP money. Instead of loaning it out to you and me, what do they do with it? They come over here and they get it. Okay, Wells Fargo, let's say Chase buys up, was it Lehman Brothers assets at $28 billion 6 months prior? They get them for $1.5 billion with your tax money. Is that a good deal for the commercial bank? Are you kidding me? They take someone else's money and they buy assets at about 5 cents on the dollar, and they immediately infuse those assets into their own stress tests, right? And then what do? They quickly get rid of as soon as they possibly can, on time cost of money, they get rid of the TARP buyout, and they own the assets. So all these people, how do they get them for pennies? How do they get them? They cut you, who bought term, invested the difference, they cut you out. They said, sorry, Wachovia stockholders, Lehman Brothers, Goldman Sachs, AIG. They said, you're now in default. You don't get anything. It's toilet paper. We're going to sell the assets over here. We're going to broker that over here at Bank of America. And guess what? They own them now, and they get a clean slate. They can resell the stock underneath Bank of America. Okay? So all of a sudden, you're cut out. Everybody that invested in that, gone. Gone, gone, gone. This thing is a disaster. Merrill Lynch is over here. Okay? These guys own all the assets now. Go look it up. They own all the assets over there. So here's what I learned, by the way. A lot of mine, that I had all my notes, were over there. They were offering the best terms for my construction projects. So of course I was with Countrywide, IndyMac, Wachovia, Washington Mutual. All of those gone almost overnight, right over here. Okay? So these guys consume everything, like commercial bankers. Okay? Why did Goldman Sachs survive? Why were they picked out? Goldman Sachs survived. How did they make it? Goldman Sachs survived because on Sunday night, they were going bankrupt and being sold Monday morning. Sunday night. Who works on Sunday? What bankers work on Sunday? None. What politicians work on Sunday night? None. But somehow they got a commercial charter. And Goldman Sachs got to go back across fence lines as the only one. They did some things for AIG, but they still never come over. And they got a commercial charter, they got to survive that way. And so they were able to retain their assets. They gave them time to meet the stress test on their tier 1 capital that they didn't have. And they came over here, okay? They survived over here. Well, what did that mean to you as an insurance agent? Okay? What relevance does this have? Keep track of my time. The relevance of this is that there is a massive transfer of wealth happening right now. Massive. Nobody has any confidence right now in stewardship of Merrill Lynch, of Edward Jones. Now is the perfect time to be an insurance agent. If there was ever a perfect storm of QS2 and economic global conditions, it's the perfect storm. It's an absolute Category 5 hurricane. And by that I mean wealth is now fleeing these sources and is available for stewardship inside insurance companies. Do you guys know what insurance companies are regulated at, by the way? I need to put that on the board. Why was money fleeing out of the insurance industry? How are they regulated? Is their capital assets to be liquid?
Very tight.
1 to 1. I put that other finger up and it's gone. 1 to 1. And they're even more liquid than that. If you look up all of their vital signs and you go through their Comdex ratings and you go talk to them, they're more liquid than that. So how is it that these stewards of wealth are 1 to 1 and we don't have any money going in there? Well, at times of distrust and tumultuous times, wealth right now, guys, I'm telling you, I've never seen that. It's unbelievable. There's an amazing amount of wealth available that's just waiting for your stewardship. Okay? And it's not just about selling protection, whether it's a car, a home, a life. Maybe it's a critical illness or something, which is really important as well. We're talking a massive opportunity to transfer wealth. Okay? So all of a sudden, this is going on like crazy. And it's going back and it's fleeing to safety. Okay? So when we start to talk about getting into insurance, we're talking about who is the best stewards of money in the world? Nobody's going to win when I start arguing with you. The best stewards of money in the world are insurance companies. The last people that will die financially. I'm giving you all this information that took me many, many years to acquire. I've got massive files and stock on this. And by the way, what do we value most in life? What we earn. You might not value this very much because I've given it to you for free. We charge a lot for it. And if you're in my brokerage, it's mandatory and it's valuable stuff to me because it makes a big difference on when I sit down to talk to somebody about their finances. If you're looking for the last place on earth money's going to go and default out of, it's insurance. It's with your insurance carrier. That's the last pile of money on earth. Okay? That's got to feel good if you're representing us, that type of a strength financially of where we're putting our money. This is a very safe place to put your money. Now, as soon as I tell somebody it's the safest place on earth to put your money, what's the first thing that they think? What's reactionary? What's that?
No return.
Yeah, you're thinking, okay, safety negates opportunity, right? So now all of a sudden we're over here, and that's what I was thinking over here, because I was young and dumb and had a lot of money, and I wanted to make the biggest ROI I could, so I was dumping it all into all these high-risk things and trying to get Edward Jones and Merrill Lynch to leverage my retirement, right? Well, so what we learned is a few things about the way that this wealth works. And the reality is, they came up with some really good math in the 90s, annuities adopted it, and then we went away from ULs and VULs, right? We got away from that, and now we do indexing, right? It's actually really good math. We've done a lot of work over years on understanding indexing and perfecting indexing. But the indexing works so well, that who else started using it? We even offer it through QS2. Indexed CDs. If a bank is using that formula, you think it's probably pretty good math? That's dang good math, okay? So they said, we can't compete. Liquid enough assets to be considered Tier 1 capital.
This is from banks. The banks have to
The
have
banks, that's why I put underneath the banks.
cash.
Cash, currency. We'll put cash and currency. Okay, they do. That's considered liquid enough to be a Tier 1 capital. That means the foundational liquidity of a bank. Everything. By the way, they took all of my inventory. And they left me with nothing, okay? Of all this, currency, is currency volatile? Every day, go look at Market Watch on Wall Street Journal. the pound, the euro, the dollar, right? It's all over the place. Bonds, not so much if they're really careful, right? What about gold? It was at 1,700 at one point. I think it's at 1,400 now. I don't know where it is. But precious metals are all over the place, right? Okay, how volatile is this? How does a banker look at his BOLI account?
Safe place.
There's no better place for a banker to minimize risk and volatility than in his BOLI cash account, which he can tap into and bank out of at the same time being regulated as liquid. They know stuff that we don't know. They're doing stuff that we don't do. Was I angry at the banks at first for taking all my assets? Everything I worked for 15 years of building? Yeah, I was kind of mad. I was really mad at the banks. And then I got thinking, after consulting with a few smart people, and said, wait a minute, if we could not be mad at the bank, but do what the banks do, would that be smart? How about we just do what the banks do and not be mad at the banks, right? Because this information's a tightly held little club, and they know how to leverage this, okay? And I don't think you understand how much they know how to leverage this. They'll take your savings account, they'll take your checking account. How much do they pay on your checking account? To have your money, okay, all they need to do is keep it in long enough for 1 month to get an average monthly balance. What can they do with an average monthly balance?
Make a loan.
They can then leverage that amount to go out and loan at this ratio, okay? So, why are we discussing so much about the banks? The banks have a lot of tricks that we can leverage with our clients that are transferring huge amounts of wealth. There's a lot to be learned there. And if we can combine this type of return that the banks are doing, how often do the banks invest money in the markets? Stock. Bank of America, Wells Fargo, JP Morgan Chase, how much do they go out and play in the stock market? If at all, it's a fraction of 8%. Why aren't banks in the markets? And why are we being told to put our money in the markets? Why is that? How much do you think Wells Fargo made last year in return? Give me an idea. It's on FDIC.com. You can go type in Wells Fargo. It'll list all their assets. They have to list everything because they're FDIC insured. So they took the benefit of taking government insurance, which then makes them declare all their assets, liabilities, and profitability. Give me your best number on what you think Wells Fargo made, declared. Any of them. Local, Bank of America Ford. Regional, Central. National, Bank of America, Chase.
A couple 100%.
Nobody really gets this, but they're anywhere from 150 to 400% annually every year. What's their default rate? Default rate of a bank. At the height, let's say 2008, 2009, at its worst possible time in 80 years. Less than. Would you guys like that number on your retirement account? Would you guys like to figure out how to do that? And that's what some of these guys in here are doing. You can go on FDIC.com, you can go on another one called Bauer Financial. That costs you a few bucks, but we use them all the time. Bauer Financial, they're a private company that gathers up all of the declared earnings of the banks. They'll compile them for you and tell you exactly what's going on. So what does that mean to you guys? Why have I told you all of this? Did you know that the whole beauty of what we do, a lot of us, that it's getting a big voice out there, insurance, people don't understand what you can do in insurance. And what the insurance regulators and the federal government allow you to do inside insurance is amazing. It'll blow your mind what you get to do inside insurance. It's unbelievable what you can do out of an IUL, whole life. We set records with Mass Mutual on transfer of wealth, with how much whole life we could write. And then we started figuring out how to leverage North America. We met with North American, we met with Allianz, we met with Aviva, and we said, this is what we want to do when we transfer wealth, and will you do it? Can you underwrite for it? So we had to meet with their underwriters, and we had to meet with their actuaries, right? And we said, okay, we're gonna start sending these type of 5-pay, 7-pay, single premium, right? You start hearing all these things where we can dump cash into whole life insurance. It doesn't matter, it's still primarily for death benefit, just like BOLI. But then you can start to do some things with it that's amazing. And so here you've got this amazing permanent insurance, as safe as can be, and you start to leverage, like a banker, that cash that's sitting in permanent insurance, and you start to spend the cash, all while you still have recognition of a growing death benefit, while you still have a growing cash asset, and then you plug the returns back into your life insurance policy. How often do you think my investing clients leave the market? How often do I win in an argument against the Edward Jones guy, the Merrill Lynch guy? Okay? I'm just telling you, there's a lot of wealth out there, and as you guys go out there and you're recruiting and you're talking to people, it starts foundationally exactly what Kelly's telling you, and Mike and Jason are telling you. We start out with property casualty, and we start out with life. But what really got me excited is, on a network marketing platform, how do I get to a relationship to talk about retirement money? Do I get to walk right in and have people think this is a good idea? This is very unconventional. They don't get this right away. How do I start the conversation in insurance? Mandatory insurance. I start a relationship with a client as simple as covering his autos and home. And I start a rapport, and I start a relationship. And then I work to the next mandatory insurance, which is going to be here shortly, which is health insurance, right? And I start to build clientele, and I start to build a relationship with these people. And then, what do I eventually get to? I eventually get to the real money, and eventually I get to have a conversation with them or their kids or their parents about retirement income. And it all starts with the mandatory insurance. And so when QS2, when Kelly was given his dialogue, and I was really interested, and I said, that's it, that's the missing piece. I'd already tried to design this out in my own brokerage. I didn't know enough about network marketing. I was like Gail Williams, didn't know enough about it, I needed other people to do it. This is the platform that was already built. I said, all you gotta do is plug in to a platform that's already built. And I can start a relationship on a mandatory insurance, also recruiting, opportunity meetings. People are coming in. Why are people going to move their insurance? The hardest thing about insurance, you know this? No one wants to move insurance because we're lazy. All of us are lazy. We don't want to move our property casualty insurance away from the State Farm guy we've had for 20 years. Why is that guy going to move his insurance now joining QS2?
He's part of it.
It's the opportunity, right? It's the opportunity. That's why there's going to be a massive, massive movement inside this world for us. I've already recruited over a dozen agents just into QS2 based on the opportunity that's here. Not associates, not non-people. That's just in the last 2 weeks. Because they get it. Just the insurance agents alone get that there's going to be a massive amount of transferring going on, and they want to put themselves right in the middle of the transfer of insurance. People are motivated to move right now. QS2 is going to be big. It's tiny right now, even at 7,000 or wherever we are. It's going to be 500,000, whatever it ends up being. There's going to be a huge amount of transfer going on. And anytime you can get as a person in the middle of the transfer, you are going to make a lot of money. You're going to make a lot of money. And if you don't know it, what can you do? I'm here to tell you, inside our group, and I would guess inside of all these groups, there's people that know insurance. And if you don't know it yet, the wonderful thing about a network marketing model that doesn't work in my conventional brokerage model is the guys will help each other. And why will we help each other? Because not only is there a split commission, there's an override. So there's people around you can partner with to get the information to go close and close and close a lot of insurance business. Okay? But there is a bigger vision out here of figure out why you're selling insurance. And it's my opinion that if you'll figure out why you're selling insurance, you'll be very, very successful at it. And you have a whole open platform to figure that out. Maybe it's long-term care, maybe it's term, maybe it's whole life or IULs or annuities. Whatever it is, any of those are incredibly lucrative on their own as a niche industry. You could retire in any of those. And here you've got this huge platform. You can pick out whatever you want. We've got passionate people inside your groups that can help you, train you, mentor you. We want to learn from you. I know very little. I've only been in for 6 or 7 years full-time. Kelly's been over 30 years, right? So there's a lot I still am learning. But I love what I do. I'm passionate about what I do. I've never been happier about leaving the industries that I've been in and being in this industry. I don't see anywhere in the world I want to be, but right here, right now, at this situation in time. Because if you can get set with insurance on a network marketing platform, It's an absolute storm waiting to happen. I truly believe that. And I'll just close on that. That's all I've got. Thanks.